Okay, this is quite surprising to me, even though I've been teaching this a long time, that they had the generic business cycle back. So some quite nice familiar territory for all of you guys. I know from level one, you've seen this before perhaps quite a few times. So again, my advice as far as studying this part here, have a read over, but I don't think you're going to find too much that's that surprising to you. As we go through, I'm going to highlight as well one or two of the past favourite areas as far as questions go, but I think you'll recognise most of what we have in the business cycle here. Now, when I see this diagram, the famous cycle here, one of the areas that they've always seem to love to test is around about this area here. So a lot of the slides that come through are talking about this long-term, the long-term growth, of course, trend growth over time. And you might recognise that where in the more the down period here, in that kind of recessionary period, they call this the output gap. That's the output gap. So there have been questions about recognising an output gap. One of the things I'd say about the exam, it's a lot more applied, of course, than level 1, level 2 especially. And so they're going to give you some data to recognise. How would you recognise when there is an output gap in this way? So we have this coming up very shortly as well too. Now the two main areas, the idea of expansion and contraction, they're shown on our chart here of course too. The book does give a bit of background here about this big variation in trend around the cycle. I wanted to give you a couple of stats from the book. It talks about there have been 66 cycles, 66, and they go back there since 1854. And this point about the variation is the point I want to make with you here. They're talking about it's an average. Each one lasts an average of 56 months. But the variation here is quite wide. The longest overall cycle, 128 months. And the shortest, as little as 17 months. So we know it's very, very tough to predict. When we're talking about the inventory cycle, again, the previous material had a little bit more on here. They mentioned it here just as a link to that. But they used to talk about a 2 to 4 year inventory cycle. And one of the ideas as a measure here is often the inventory over sales. And as a measure of confidence, I guess, that when firms get a lot more confident, building up a lot more inventory in this way, anticipation of more sales. So that inventory to sales ratio can be seen over time as well. But it's not quite as prominent in this year's syllabus. So we're looking at long-term expectations, but we know that the short and intermediate term, looking at things within the cycle as well. So that's where the slides are going to go here. And we have lots of link to the cycle in many parts of our syllabus. Straight away, I think about the fixed income readings much later on, where we have chapters, guys, on investment grade, also chapters on high yield, thinking about the impact particularly of high yield in those downturns too. Also, guys, we think about equities and the switch over towards perhaps fixed income as well. At the low point here, start to invest in equities to benefit from the growth coming in. As they think about the recession about to hit, the idea, guys, of switching over to bonds for that kind of protection as well. Now, this imperfect information that we have through everything means that a lot of focus on where we are in the cycle, trying to guess where the turning points might be. So we've talked about them varying quite widely there. We've talked about such a wide range of different lengths. Although everything is monitored very, very closely, the book is admitting very tough to predict the changes. Now, one of the things to talk about, guys, here towards the end here, investors' views about this. And this idea, guys, of of course, sentiment coming in as well. Not just what's happening, but what is viewed as being happening as well. People's take on this as well too. So it can be quite difficult to look, guys, at the longer term, especially when we're surrounded by perhaps panic in the short term. Okay, so we talked about this output gap as being very testable. You will find this in the past morning favourite in the exam, and there are some good ones to have a look at here. And what you had to do in this kind of question in the past are look for the clues. What are the clues that tell you there is an output gap? As the idea here, of course, GDP, of course, is lower here, and generally declining inflation was a clue as well. So typically in the morning, given some data, you had to give some evidence of an output gap coming in. However, in the kind of boom period here, overheated, notice that it's above, that's above there, of course, the long-term trend. That's below the long-term trend as well too. Now, they take you through the business cycle. No real surprises here. And we're in the initial recovery. Well, at this stage here, stocks start to do well because you're investing here at a low point in this way. They anticipate this. So with level 3, you often think about people go to the shelter of bonds, go to the shelter of commodities perhaps as well in a crisis. The minute things start to be looking up, switch over for growth. Any sign of growth, switch over in this way. And that's what's happening here. And interest rates are still low there in this way. And this anticipation, though, perhaps of something changing is coming in. Consumer confidence starting to improve as well, too. The government trying to get the economy going. Now, the expansion is picking up, but we still have that kind of, that little output gap coming in here. Confidence is starting to improve. Inflation is still pretty low. The output gap I mentioned is still around at this stage. We're not kind of at our long-term trend so far here. When short-term rates start to increase, bad news for bonds. Guys, we know you want to switch out of bonds and into equities here. Increases in rates, not good for bonds at all here. So one tip here, think back to recent times. You'll see all this play out in real life. Into the later expansion, notice, guys, we're now above the long-term trend here. And what's happening? Well, inflation's taking off. I had a look back at the UK, and this is in 1990. In 1990, inflation was something like 9.4 in the UK. We were certainly in that boom period, and interest rates actually had to rise as high as 15.4 back then. So imagine inflation back at 9.4, and the interest rates to try and stem that rise, try and slow down the economy. Now, towards the top here, what's happening to our stock prices? That leading economic indicator, of course, starting to top out and predict more of the downturn coming. Yeah, so the slowdown starts. Notice it's still above the long-term trend, but we know where that's headed because we're heading on the other path here as well. Yeah, that the policy, fiscal policy here, turning more neutral. Don't want to be too restrictive. That could be quite damaging. But consumer confidence starts to be worried. Also, high interest rates are having an effect as well too. Rates starting to fall. Where do we switch? We switch away from these growth assets. We switch to the safety of things like bonds and commodities coming in here as well. So that's quite a useful thing with level 3. That kind of switch between a flight to quality and a flight to growth. You've seen that many times before as well. Into our recessionary period or contraction period, remember the definition, 2 consecutive quarters of negative growth in this way here. And that output gap where we're below our long-term trend starting to come in a lot more there. Inflation, they're certainly peaking in that time there, and the growth less than our long-term trend, of course, too. That duration could vary. We've had a look at that data already. They say here our date, but the longest one has been 120 overall the cycle, 128 months. Now, inflation and disinflation and deflation are all mentioned here. As a quick reminder, we have got some useful slide at the very end here to apply it more to our questions. We know that inflation, well, we have rising prices, of course. We know that disinflation is a fall in the inflation rate. So it's still inflation, but the rate itself is falling. So say, guys, we go from 3 down to 1. That's still inflation, but it's at a lower rate, if you like. And then, of course, deflation being falling prices. And where the slides go here, they look at the impact on assets. That's coming up very shortly. A word though before we get there on the crisis and lower negative interest rates here as well. So if interest rates go to 0, then we no longer have any monetary interest rate policy. We can't go any lower to stimulate the economy in this way. So where do we go? We know we turn to our famous QE to try and pump liquidity, pump money into the system in this way. So again, the book is reflecting real life in this way. The scale was large, guys. These activities, the QE programs are all around the world, very large as well. This is quite testable, I would say, because they're starting to apply the idea of inflation to some of the basic asset classes coming in here. Now, notice that it's not much of a problem if inflation is already built in and expected. So for our cash, bonds and equities, one thing they talk about with bonds that's useful to mention, guys, here is inflation's part of the yield. It's part there of the yield. Guys, and we know the yield being the discount rate has a part there, I guess, the discount rate there too. So the idea of rates, inflation rising, it's not going to be good for our values of our bonds there. It's going to mean we have lower values in this way. But when inflation is above or different in terms of our expectations, think about, for example, I mentioned back in 1990 here in the UK. Well, although inflation was quite high, I mentioned about 9.4% inflation, interest rates, the actual nominal rate, guys, here was up at 15.4. And so it meant that if you had money on deposit, you could earn 15.4%. So guys, this idea of high inflation tends to be high interest rates, and that's quite a positive thing normally for our cash as an asset class. In fact, it wasn't unknown to have cash-based pensions at that time here in the UK. However, when we have inflation above here, because it's not going to be good for our bonds, and we said that they are the discount rates, and the values are going to be lower in that way. And also, guys, for our also of course the coupons, that we receive. They're going to be worth a lot less in real terms as well. Equity here, unless you can pass on, if you can pass on your costs to your customers. Always think about trains here. If you have to get a train quite a lot with work, every year you get an inflation link. They can pass that on very, very easily to us, the customer. But some companies can't do that. And finally, if you have real estate, you have property, is it good news if your values are rising? Of course, guys, it's good news for you in this way. Now, when prices are negative, when we have negative inflation in this way, prices are falling in this way, well, not good for your value of your real estate if your prices are falling. Not good, guys, in terms of your equity as well, if values are falling. If you had a minimum, guys, if you had a minimum rate, and what the book talks about here is that often for your average retail customer, guys, for your average retail or commercial customer as well, that most banks did have 0 as a minimum. However, they make the point that when you add on fees, many bank accounts have fees for things, that your effective rate could be less than 0. Think about the fees that are associated with many bank accounts. So the idea of negative rates did affect, of course, more wholesale, but not your average retail or commercial client. With the bonds, those cash flows, the fixed cash flows in the future have greater purchasing power. They do well.